China's economy is hiding 80 million empty homes. That's enough housing for the entire population of Germany. But here's what should terrify global markets. Those ghost cities aren't the disease. They're just the most visible symptom of a structural collapse that's about to reshape the entire world order. The numbers are staggering. $3 trillion in hidden local government debt, a population shrinking by millions each year. Youth unemployment hitting 17%, while the banking system sits on a mountain of bad loans that makes 2008 look manageable. This isn't a recession. This isn't even a crisis in the traditional sense. What we're witnessing is the complete unraveling of the economic model that powered the world's second-largest economy for 4 decades. And the West? We're completely unprepared for what comes next. For 40 years, China's growth seemed unstoppable. Double-digit GDP increases, gleaming cities rising from farmland, a manufacturing powerhouse that became the world's factory. Western corporations moved their supply chains there. Emerging markets tied their futures to Chinese demand. Everyone believed the 21st century would belong to Beijing. But beneath the surface, something was fundamentally broken. The property sector that once drove 30% of China's economy has imploded. Evergrande, with its $300 billion in liabilities, was just the first domino. Country Garden followed, then China South City. Now even state-backed developers are failing. I'm James Whitfield from Faultline Economics. While others chase headlines, we examine the systems that actually shape history, geography, demographics, and economic fundamentals. Today, we're analyzing China's structural collapse. This is strategic clarity in a complex world. Let's turn to the strategic map. China's economic miracle was built on 3 pillars: massive infrastructure investment, a property boom that created wealth for hundreds of millions, and an export machine that supplied the world. Each reinforced the others in a self-sustaining cycle. Local governments sold land to developers, used the revenue to build infrastructure, which attracted more development. Families poured their savings into property, creating demand. Exports brought in the foreign currency to keep it all running. But look closer at the data from 2024 and 2025. Property investment has crashed 60% from pre-pandemic levels. Land sales revenue, the lifeblood of local governments, has plummeted from 8.9 trillion RMB at its peak to under 3 trillion. The export engine is sputtering as the US and Europe de-risk their supply chains. Now, here's where it gets interesting. This isn't just an economic story. It's a demographic catastrophe meeting a debt crisis, meeting a geopolitical realignment, and they're all accelerating simultaneously. Factor 1. The property implosion. When 30% of your economy vanishes, the scale of China's property disaster defies comprehension. We're talking about 65 to 80 million empty homes. He Keng, former deputy head of China's National Bureau of Statistics, admitted that 1.4 billion people, China's entire population, couldn't fill them all. But empty homes are just the beginning. Evergrande alone left 800,000 pre-sold but unfinished units. Ghost cities, like their cultural tourism city in Jiangsu province, now being reclaimed by nature. These aren't just failed investments. They're broken promises to millions of Chinese families who bought homes that will never be built. Let me show you exactly what I mean. Property directly contributed 6% of GDP, but including related industries like construction and materials, it drove up to 30% of China's economy at its peak. When property collapses, everything connected collapses with it. The psychological damage may be even worse. For decades, Chinese families believed property prices only went up. Real estate represented 70% of household wealth. That social contract is now shattered. Consumer confidence has evaporated, and with it, any hope of transitioning to a consumption-driven economy. Factor 2. The debt mountain. 303% and climbing. Beyond the headlines, there are systems. And China's debt system is reaching a breaking point. Total debt hit 303% of GDP by the end of 2024. But here's what they won't tell you. It now takes 5.52 units of new debt to generate just 1 unit of GDP growth. The real bombshell is in local government financing. Local government financing vehicles, LGFVs, hold between $7 and $11 trillion in off-balance sheet debt. These vehicles use land as collateral to fund infrastructure. With land values collapsing and sales revenue gone, they're essentially insolvent. 12 of China's 31 provinces are spending over 100% of their monthly fiscal income just servicing debt. This isn't sustainable. It's mathematically impossible to continue. The shadow banking system adds another layer of risk. Wealth management products, trust products, all promising high returns by investing in property. These operate like a Ponzi scheme, requiring constant new investment to pay maturing products. With Zhongxi Group and Sichuan Trust collapsing in 2024, the contagion is spreading through the financial system. Factor 3. Demographic destiny. The population bomb explodes. This changes the entire equation. China's population fell by 1.39 million in 2024, the third consecutive year of decline. The birth rate hit a historic low of 6.77 per thousand. The fertility rate, between 1.0 and 1.2 children per woman, far below the 2.1 needed for replacement. China is aging 59% faster than Japan did during its demographic transition. By 2024, 22% of the population was over 60, while the working-age population shrank to 858 million. Oxford Economics projects this will cut potential GDP growth by a full percentage point annually through mid-century. But all of this hinges on one deciding factor: the pension system. A 2019 report warned China's main pension fund would be depleted by 2035. With fewer workers supporting more retirees, the math simply doesn't work. China faces an impossible choice: default on pension promises, crush the younger generation with taxes, or face fiscal collapse. If you find this analysis valuable, subscribe to Faultline Economics. We dive deep like this every week, examining the forces that actually shape our world. But all of this hinges on one deciding factor: global decoupling. China's attempt to export its way out of crisis is triggering a protectionist backlash that's slamming shut the very markets it needs for survival. In the first half of 2025, Chinese exports to the US fell 10.7%. The EU, US, and even emerging markets are implementing tariffs on Chinese EVs and solar panels. Mexico has overtaken China as America's top trade partner. De-risking isn't just a buzzword, it's a fundamental rewiring of global supply chains that's permanent. Now, let's connect the dots. What do you think is the most critical challenge for China in the next decade? Drop your insight in the comments. I read every one. Given these dynamics, we're not looking at a sudden collapse, but something potentially worse: a managed decline that could last decades. Beijing's response? They're not solving the crisis. They're containing it. The stimulus measures of 2024 to 2025, rate cuts, RRR reductions, the increased deficit target are too small and misdirected. Beijing keeps pumping money into manufacturing and new productive forces like semiconductors and EVs. But China's problem isn't supply, it's demand. Consumer spending is just 40% of GDP compared to 70% in the US. This extend and pretend strategy keeps zombie companies alive, traps capital in unproductive assets, and ensures a Japanese-style lost decade. But from a much lower income level and with far worse demographics. For a deeper dive into China's structural challenges and what they mean for global stability, I recommend Red Flags: Why Xi's China is in Jeopardy by George Magnus. It's an eye-opening analysis that perfectly complements today's breakdown. Check it out with the link below. This analysis connects directly to our video on Russia's geographic prison. You can find that breakdown in the card on screen and linked in the description. It reveals how geography and structure limit even the largest nation's power projection. So, what does this mean for the global balance of power in 2050? If current trends continue, China's economy will stagnate at around 2 to 3% growth through the 2032nd. The population could fall below 700 million by century's end. The property sector will never recover to previous heights. But here's the strategic implications. A stagnating China is potentially more dangerous than a rising one. Economic weakness at home could drive aggressive nationalism abroad. The peak China hypothesis suggests Beijing might act on Taiwan before its relative power declines further. For the West, China's collapse means inflation as supply chains reorganize, the loss of the world's largest consumer market for growth, and a more unstable geopolitical environment. The assumption that economic integration would moderate China's behavior is dead. We're entering an era of parallel economic systems, technological decoupling, and heightened conflict risk. The data doesn't lie. China's structural collapse isn't coming, it's here. 80 million empty homes, 300% debt to GDP, a shrinking population, and a world turning away from Chinese exports. This isn't a cyclical downturn that stimulus can fix. It's the end of an entire development model. The property bubble has burst. The demographic dividend is exhausted. The debt mountain is insurmountable. And the global environment that enabled China's rise no longer exists. Beijing can manage the decline, but they cannot prevent it. For investors, policymakers, and anyone trying to understand the next decade, the message is clear. Prepare for a world where China is no longer the growth engine, but a source of deflation, instability, and strategic uncertainty. The future isn't written, but the blueprint is there for those who know how to read it. If you gained something from this analysis, subscribe to Faultline Economics and give this video a like. We're building more content like this every week. And as always, stay strategic,